I had a meeting with Jonathan Shelon and James Maund, portfolio managers of KLIP, which is popular these days, with a super high distribution rate about 40% as of September 1st. KLIP is managed by Crane Shares. The asset under management of Crane Shares is approximately $13 billion. KLIP is covered call product that writes call options, whose underlying asset is Kwab, which invests in Chinese internet companies. Popular cover call products such as JAPI, TASLI, and QILD have various management strategies. So you must be careful when investing in them and understand the risk of each product. What assets does Kwab, which is an underlying asset of KLIP, invest in? Kwab invests in Chinese internet companies. Is the KLIP managed actively? It is not completely managed actively, but managed based on rules. KLIP doesn't have a benchmark index to track, but we have very specific rules when writing options. What are the rules? We write the at-the-money calls, not in-the-money nor out-of-money calls. The other rule is that we write options that are at least 30 days in length. So normally we have 10 options between 30 and 40 days. What experience do the KLIP portfolio managers have? James and I have extensive experience in management. I've been in the industry 30 years, and we want to provide very clear outcomes to our investors. Why do you decide to select the Kwab as an underlying asset among many different assets? What are the advantages of Kwab as an underlying asset for covered call products? In order to provide a high distribution rate, two factors are very important. First, high option liquidity. Second, high volatility. Regarding high option liquidity of Kwab is very high. There is over $3 billion of notional exposure in KLIP Options, which is the second largest option market among China ETFs. So we thought pairing Kwab and KLIP together would be valuable for our investors. Regarding high volatility, Kwab historically has had much higher volatility than other major indexes. The implied volatility is 10 to 15% for the S&P 500, then about 15 to 20% for the NASDAQ 100 and the Russell 2000. But the volatility of Kwab is about 40%. So we got very excited to be able to offer 4 to 5% distribution yields for KLIP. Lastly, an additional advantage is that we own Kwab itself inside of KLIP, meaning that we are not writing options on an index, but on Kwab itself. It is efficient from a US investor standpoint. It helps to keep spreads very tight. It's a cost-effective strategy. Some investors say, in order to maintain the higher distribution rate, the fund sells the Kwab. Otherwise, do the distribution solely come from the option premiums? Where does the distribution come from? No, we are never selling Kwab itself. We solely pay out the income that we earn. Sometimes our cash position gets up to like 5 to 6%. And then our cash position shrinks right now. Our cash is 0.66% because we just paid out a distribution yesterday. That was our payday. We paid out 4.5%. Do you cap monthly income? No, we do not cap monthly income. We are paying out the income that we earn. Some companies have chosen to cap what they pay out, but we don't. We make our strategy as simple as possible. As we see the holdings page, what does Kwab US 0908-2023 C29.51 mean? It means it wrote 155 call options on Kwab at the price of $29.51, whose maturity is on September 8th. When they expire, we roll them out at least another 30 days and collect another 4.5 to 5% premium income. What is the worst case scenario for KLIP investors? So the worst case scenario for KLIP will tend to be a scenario where Kwab is at a very high price when you enter and has a lot of downside risk because KLIP has to absorb the losses that Kwab experiences. In an interesting manner, the best time to buy KLIP is actually when Kwab's price is low relative to history, like it's today. Right now, Kwab is trading at $30. Kwab in February of 2021 was as high as $100. What type of investors are suitable for KLIP? What type of investors should consider investing their money in KLIP? First, when you buy a cover call strategy, what you're doing is replacing the upside with something more certain and steady. And so what happens is, if Kwab is going to be up 100%, KLIP is not going to be up 100%. It's going to underperform. However, if Kwab is going to be down 50%, you're going to have a cushion for KLIP because you earn this income every month. So you're not going to be down 50%. A good example is actually the month of July. Because in the month of July, Kwab was up 16% just in 1 month, whereas the total return for KLIP was only up 6%. So even if you didn't get 16%, you got 6%. It's still good because you have less volatility. Now, in the month of August, Kwab was down 8%. KLIP was flat. That's the trade-off. Kwab behaves differently than many other asset categories, US equities and US high-yield dividend-paying stocks. I could understand the reason for the high distribution rate. It seems like KLIP is systematically managed based on rules and principles. Since a stable distribution rate results from high volatility, we'll keep track of the performance of the KLIP portfolio managers. If you like this video, don't forget to like and subscribe.